Hello and welcome to this video on Chattels and Losses with myself, Sue Cox. In this video, I'll start by looking at some of the capital gains tax exemptions. These are frequently mentioned in the case studies, and if you've read the examiner's comments, they are often missed by candidates. Next, I'll be covering the lovely chattels, and we'll end with looking at the two different types of losses and how these affect the capital gains tax calculation. Starting with capital gains tax exemptions, there are some obvious ones here, for instance the annual exemption. And don't forget, this amount is detailed on the tax tables, which you will receive in the exam. If you don't use the exemption this year, you lose it, as it cannot be carried forward. If you sell your principal private residence or private car, the good news is that they are both exempt from capital gains tax. Another great exemption is the transfer between spouses and civil partnerships. At the time of transfer, there is absolutely no capital gains tax liability. However, when they sell, that's when the liability is calculated. But hopefully the reason for the transfer is that the person was a lower taxpayer, and it means that less capital gains tax will be payable. Next, we have some investments which are exempt from capital gains tax. These are government gilts, national savings and investments, ISAs and junior ISAs, and lastly, venture capital trusts. And don't forget, the enterprise investment scheme is not exempt from the outset. You need to hold these for at least 3 years to become exempt. Foreign currency for personal use and foreign currency bank accounts are exempt, as well as gambling and lottery winnings. And lastly, be careful when the case study mentions war medals, which it has done in the past. If the medal is sold by the original person that was awarded it, then any gain is exempt. However, if, as it was mentioned in a previous case study, the war medal was left to a son in a will, and then the son sold the medal, the gain would not be exempt from capital gains tax. Now on to the lovely chattels. The word chattel is a legal term meaning an item of tangible, movable property, something that you can both touch and move. Your personal possessions will normally be chattels and include items such as jewellery, paintings, antiques, crockery and household furniture. For chattels to be exempt, the disposal price must be under £6,000. If it's more than £6,000, then a chattel is not exempt. And both the normal capital gains tax calculation and a special chattels calculation is performed to see which is the more beneficial for the client. The good news is that the £6,000 chattel exemption and the 5/3 part of the formula, they're detailed on the tax tables. The bad news is you need to know how to apply it to be able to work out the chargeable gain. This slide should help you. I mentioned that you would need to do two calculations, the chattel and the normal capital gains tax calculation. Let's start with the chattel calculation. The most common mistake that is made here is that candidates deduct the acquisition price and costs. Unfortunately, this is not allowed. In the chattel calculation, you have to ignore the price paid and any costs. But instead, you deduct the exemption allowance of £6,000. So we start with the disposal cost, then we deduct the £6,000 and multiply by 5 and divide by 3. That's the 5/3 mentioned on the tax tables. The answer on your calculator will be the chargeable gain. In the normal capital gains tax calculation, we also start with the disposal price, but this time we can deduct the acquisition price and all the costs. The amount left is the chargeable gain. Whichever chargeable gain is the lowest is the one that the client will choose to detail on their tax return. Let's have a look at an example and then work on both calculations to see which is more beneficial for the client. I'll read the question to you, and then if you feel confident, please press pause, and you can do this on your own. If you don't press pause, be aware that the answer will be on the next slide. I bought an antique mirror at auction for £1,900 and I paid £240 in auction costs. I sold the mirror at auction 7 years later for £9,000 and my auction costs were £650. The task is to calculate my chargeable gain on disposal. Let's do the chattel calculation first. Disposal price of £9,000 less the exemption of £6,000 equals £3,000. We multiply this by 5 and divide by 3. The chargeable gain is £5,000. Now the normal calculation. £9,000 less the acquisition price of £1,900 and less the costs, which total £890. And this equals £6,210 chargeable gain. Therefore, we would recommend that the client use the chattel calculation, as this is the lowest. And remember, this is the chargeable gain, which means that the next stage will be to deduct the annual capital gains tax exemption. By choosing the lowest chargeable gain, it means that the client would have more left of the exemption allowance towards other sales that they might make in this tax year. Now moving on to losses. There are two types of losses that you could have. The first one is a loss that is made in the same year as the gain. If this happens, the loss must be deducted from the gain first, and that's before the annual exemption allowance is deducted. The second loss is a carried forward loss, and this time the loss is deducted from the taxable gain, which means that the annual exemption has already been deducted. Let's have a look at how the losses differ. In this first example, you can see that I've made a gain of £20,000 and also a loss of £10,000 in this tax year. The loss of £10,000 is deducted from the gain, and the chargeable gain is £10,000. From this, I can deduct the annual capital gains tax exemption of £12,000. It means that there is no taxable gain, so no capital gains tax liability, but I have an unused annual exemption amount of £2,000. If I don't have any other gains this tax year, it means I will lose this as it can't be carried forward. Now let's compare this to a carried forward loss. This time we deduct the annual capital gains tax exemption first from the chargeable gain. We now have a taxable gain of £8,000. The carried forward loss is now offset from the taxable gain. There's still no capital gains tax liability, but this time we have £2,000 of our carried forward loss left. Now the rule for carried forward losses is that you can carry them forward indefinitely until you use them up. And that's why it's always best to have a carry forward loss rather than a loss which has been made in the same tax year. This is the last slide for the video and is a quick reminder of the capital gains tax calculation, including both types of losses. The first step is to determine the disposal proceeds, which is the sale or the market value of the price of the item that you are disposing. The second step is to deduct the acquisition cost, which is the amount to purchase the item. The third step is to deduct any acquisition, disposal, or even enhancement costs. The fourth step is where we deduct or offset any losses which have been made in the same tax year as the gain. We now have our chargeable gain, and that's why the fifth step is to deduct the annual capital gains tax exemption. Once the exemption has been deducted, the gain is then known as the taxable gain. Any carried forward losses from previous tax years are then offset, and this is step 6. The last step, which is 7, we add the taxable gain to the individual's taxable income. This is to determine what rate of tax will be liable on the taxable gain. This could be 10% for basic rate taxpayers or 20% for higher and additional rate taxpayers. And don't forget, if they are selling a property which is not their main residence, they would have a surcharge of 8%. And that brings us to the end of this video.